We're going to start today by looking at the S&P 500 like we usually do. You can see that we're firmly above all of the major moving averages. We have a 50-day moving average, 100-day, 150, and 200-day. That's a sign of momentum. You can see that we're levitating above the 50-day, which is the purple line at the top here. And you can see we're overbought right now. We're at 88. That is pretty high. So um, we're in a seasonally really good time of the year. We have, let's see, okay. So if we look at our stochastics, you can see that we're at the top of our range. We're overbought, and we're at the top of our channel. The channel has been very, very reliable for the past 2 years, and we're at the top end of that. So we knew when we started this year, this month, we are in some of the better parts of the month. We've actually had one of the best Novembers in recent times. So November turned out to be this seasonality turned out to be very good for us this year. And December is usually a good month too. So we're going into December, so we have to keep in mind that um, we're overbought now, but we still have some momentum. A lot of momentum has to deal with the incoming administration being business friendly. So let's keep that in mind as we go through some of our talking points. Okay, so if we look at our calendar, um, we've been signaling out the Thanksgiving week as a good week since the beginning of the year. Um, that's because around the holidays, people are usually happier, and there's light volume on the day before and the day after holidays. So you have to keep that in mind, even if it goes down a lot or up a lot, it's light volume, so you can't take it. You have to take it with a grain of salt. The things we have to look forward to in the next month are we have the Fed meeting in the middle of December. They'll tell us interest rates, um, where they're going to be going with interest rates. And we don't have many earnings reports coming out. The earnings reports start in January, and February is when a lot of them come out. So we have a period of time right now where we don't have a lot of news for the stocks. We have a lot of geopolitical news, we have the CPI coming out, but there's not a whole lot of things going on in December. So now let's look at some of our other talking points. We have momentum picking up. We had 70% of the S&P stocks above the 50-day moving average. And then we had 76% above the 200-day moving average. So this is a sign of momentum. That means if you have a certain amount invested right now, there's a chance you'd want to hold that most likely until probably the end of the year because we do have this momentum. We have um, the U.S. Treasuries. Our general formula for the past 2 years has been if the Treasuries go down, that's good for the stock market. If they go up, it's bad for the stock market because as as you have an alternative to invest to stocks, um, if the alternative to stocks, such as bonds, are yielding higher than what the stocks will return, then the people will not pay as much for stocks. That's the general theme. So right now we had the U.S. Treasuries go down 5%. That is a lot in a week. So what else do we have? All right, we have, okay, so our themes for this year, return to the mean, healthcare, telecom, financials, energy, and utilities. Um, did bad last year, and so far they're doing pretty good this year. Financials this week turned into the best sector of the year. surprising. And utilities is like the third best. So energy is one of the only ones that has superiorly lagged in the past couple of years. So one would say that might be due for being one of the best next year. All right, so let's look at some of our, we already mentioned this, we're at 88 in the stochastics. You can't really get much higher than that. So we're super overbought. We're at the top end of this range. If we look at our calendar, we had a really good week. This is one of the best months in recent time, best Novembers in recent times. So it was a very good November. Um, we could pull back a little bit in the stock market for the next week or two, but almost always we have this Santa rally. Everyone knows it's coming. We have two holidays in a row, Christmas and New Year's, and this time is like usually blocked off by the stock market as a rally time where there's a Santa rally. So if we pull back, it's going to be like around here, and then might be based on a government report, and then we'll probably rally towards the end of the year. But the reason why we keep track of these seasonality trends is that um, if you're investing new capital, if you have some more money to invest, you'd want to invest it when everyone else is selling, and that's why we have these um, we plan our buys and sells based on the stochastics. So you can see almost every one of our stocks so far this week is overbought. So you can see that almost everyone is overbought. We're looking at this spot right here. This is the only sector that's um, oversold. It's the utility sector. So you can see this is out of favor right now. It's in an uptrend. So you can see that it's at the bottom of its channel. This is the only sector that's pretty much being sold while all the other sectors are being bought. And usually when that happens, this is a sector that turns around. Let's look at other sectors. See, you can see energy is kind of in the middle. It's not oversought, no, not overbought, oversold. Um, you can see this stock, Google is oversold. You can see that its stock is um, 24 in the stochastics. And it's holding up above its 150-day moving average, which is pretty good. But you can see this is very reliable upward trend line. And it has a lot of antitrust issues right now that it has to work through. But in general, its earnings estimates aren't changing. So we'll see if the new administration will be as tough on the big tech stocks as the current administration. All right, so let's look at some of our more of our talking points. Okay, so we have, wait, where were we? Okay, we're right here. Okay, so you can see we're back on a um, pattern where as the U.S. Treasury goes, the yields go down, we see the stock market going up. So let's see if that inverse correlation continues. It was since around November 8th, we had a very interesting dichotomy where the interest rates for the 10-year were going up and the stock market was going up. Until then, in the last year, it was a inverse correlation. It may be that we're having that inverse correlation continue starting this week. Okay, so right now we see the price of oil go down 4% this week. That could be because um, if the new administration allows for a lot of drilling in America, that could bring the price of oil down. That's one thing. The other thing is we have geopolitical tensions and possible um, possible Saudi Arabia said that they might start to pump a lot of oil and flood the market to um, and if they do that, the price of oil goes down. That was the news of this week. And they would do that to pressure Russia because Russia gets a lot of their money from oil. And if the price of oil goes down, Russia might collapse. Um, so let's see some of our, let's see, wait. Okay, let's see if some of our issues that may lead to a crash. Something that came up this week was the ruble, which is the Russian monetary um, is the Russian dollar. The ruble has gone down and it is collapsing. That could be a potential crash scenario if Russia somehow financially collapses. If Saudi Arabia pushes a lot of oil onto the market and Russia can't pay their bills, there could be a major catastrophe in the stock market. So we don't know what's going to happen there, but we always keep track of issues that might lead to a crash. And that just came up this week. So we'll keep our eye on that. How does that affect companies that we're watching, like Google and Microsoft and Apple? Mm, we don't know yet until we look into it. So um, right now, I don't think it affects them very much. So a lot of times, whenever you're buying and holding stocks, you have to consider the news and how it relates to your stocks. And that's like a daily task that you have to do. All right, so let's look at some more of our talking points. We have the US dollar index. It's down 1%. You can see that the dollar has been appreciating in a major way since the election. And this week, just this week, it went down some. So this totally affects the price of oil, commodities, gold. So everyone's watching the dollar right now. And it seems like the new administration would promote a lot of growth in America, and that could lead to a stronger dollar. This totally affects the commodity prices. So let's keep our eyes on this dollar index. What else is happening? Gold is actually down 5% this week. Let me see. A stronger dollar tends to drive gold prices lower. So we have a stronger dollar right here for the past two months. And that should drive the price of gold lower, but didn't this week because the US dollar was down this week and the gold price was down also. So that wasn't a correlation that we thought, but um, we'll keep watching it. All right, so our fear and greed index is currently greed. We had greed 61 last week, so we're greedier this week than last week. So in our formula here, if the rest of the stock market is greedy, you got to take some profits off of the table or don't buy. And you can see from our stochastic charts that almost off the charts, everywhere we're looking, it's overbought and we're at the top of our ranges in general. So we might gravitate towards the end of the year in this overbought nature, and we'll probably hug the top of this trend line in almost all of our charts. We don't know. But right now, when everyone else is greedy, it's not the time to buy or to get excited. Um, what's interesting about the amateur investor survey is that this is the first week in like, at least a year that the most of the participants are bearish. You can see it's bearish 38 versus bullish 37. So you have a lot of squeamish amateur individual investors right now. We don't know why, but that's like a contrary indicator. So we have a couple contrary indicators. We have a lot of bullish um, people that are excited on the stock market, and now we have some bearish amateur investors. So let's keep looking at some of our talking points here. We have VIX at 13 right now. That is a year low. So people are not at this point in time buying protection or afraid in the stock market. So the translation is, you know, if it's 13, then people are not afraid and they're going to keep buying more. So in our emotional graph, we're currently greedy, getting up to a delusional state. We have a couple major themes. We have AI. Today we had some semiconductors go up a lot due to an administration signal that we're going to be easier on chip exports. So we have some delusion and we have people excited towards the end of the year. Um, Things that could cause a crash. There are threats of nuclear war. If any kind of nuclear war started, there would definitely be a 20 or 50% correction in the stock market. It would be off the charts. Um, okay, we have random Trump actions or words. We have this week, we have Trump saying that we're going to tariff all imports. And that totally affects the business model of the companies we're watching. So whether that happens or not, we don't know, but it's been threatened before and it could be used as a negotiating tool. So you can't take these random Trump words as a gospel. We just have to make our best guess if it would affect our current position. And if so, we have to maybe scale down a little bit. But right now, that's just talk. It's not something that's going to happen for sure. Okay, so um, for the downgrade of the debt, high treasury rates, and problems with the current debt of America, we do have a new administration that could help reduce expenses. So we could grow ourselves out of the debt. There's a little hope for that. So we're going to keep our eye on that and see if we can actually balance our budget and get control of our debt. And if that happens, we won't have this worry on our issues that may lead to a crash anymore. All right, let's look at some more of our talking points. Our first to worst. Beginning of the year, we had the best performing sectors from last year. Actually, they're performing very good this year, but we can see that utilities, the worst of last year, is turning out to be one of the best of this year, 30% up so far this year. We had financials, now the best performing sector of the year. So that is very important lesson from the beginning of the year. We had a couple sectors, healthcare and energy, totally bomb this year compared to last year. The 2 years in a row of subpar gains for these sectors. So as a contrarian, you'd say, well, multi-years of underperformance could yield to outperformance next year. So let me see. All right, so that was a really good exercise we did here, and it turned out to work this year for the most part. Now let's look at the total year-to-date performance. We had financials, number one, communication sectors such as Google, Microsoft, Google, Facebook, they are up 34%. IT is next, utilities, S&P, industrials. All right, so we do know that in the next administration, there's going to be deregulation. So we're going to have healthcare probably continue to struggle because there's a new person in charge of the healthcare in America, this RFK, and he might still wreak havoc on that sector. I don't know. But real estate, they still don't have a catalyst really for we don't have interest rates changing a lot. We have the price of the mortgage, even though the Fed is reducing their rates, we still have a high mortgage rate. So with to watch that, energy is one of the sectors that should be outperforming next year. Let's look at some of our sector ETFs. All right, so first of all, let's look at the 10-year. Okay, the 10-year today is down a lot. Look at that. This is a huge move for the 10-year. And you can see in the past week or so, we've gone down an extreme amount, probably 5, 6%, 7%, something like that. Um, so as the 10-year treasury, let's look at our formula. Okay, so the yields of the 10-year going down, that's positive for small caps or heavily indebted stocks because the cost of finance goes up as the yields, well, as the yields go down, it's better for small caps because it costs less to refinance their debt. You have high yielding stocks such as utilities, healthcare, and staples. They do good whenever the price of the 10-year yield goes down. Home builders, okay, so whenever the yields go down, it's more affordable to buy houses and refinance. And we have REITs. They okay, they're also a high yielding entity that goes up whenever yields go down. So let's see if that, and then let's see if that is happening today. So let's look at our sectors. Okay, we had a news story today about the new administration is going to be softer on semiconductor exports. So that really helped that sector, the semiconductor ETF, along with the tech sector. Um, so we said, you see, positive for high yielding. Let's see if the high yielding is doing good today. Telecom is high yielding. We have healthcare is high yielding. Let's look at the ones that did the worst. Real estate. That's surprising because if the yields go down, that should make real estate more affordable. So that's unexpected. And regional banking. So so as the yields go down, negative for negative for banks. Okay, so that made sense that we see banking going down today. And we have the bank ETF. We have um, biotechs. Okay, so okay, that was a good little exercise. Um, let's look at some of the stocks going up and down the most. We have Tesla. The theme on this top 10 is mm, highly indebted stocks and AI plays. Okay, so let's look at them. One is Tesla. They're an AI stock and they're a Trump trade in general. That doesn't seem to stop right now. We have First Solar. That's interesting. They do solar installations and they went down a ton based on the Trump trade. And I guess it's a reversion. It's actually starting to recover a little bit. Vistra, they do AI infrastructure for the um, AI build out in the data centers. We have Lam Research. We have okay, Lam Research. They do semiconductor servicing. So the news about the government being soft on the semiconductor industry today that helped that stock. And Las Vegas Sands, they are heavily indebted, so they might have done better because of the lower interest rates. We have Wynn and MGM. A lot of resort and gambling stocks are up today. And Dell is up. Then let's look at what's down the most. Super Micro, we have yeah, a lot of banks. So as the yields go down, then the banks, insurance companies, brokerage firms, and insurers would go down. So we see a lot of those in the top 10. Um, all right. So that was a good little exercise. I don't see any other combinations there. All right. So let's look at some more of our talking points here. Okay, Dan Now's picks from the beginning of the year. We have Amazon is up 35%, Meta up 70% after this week. We have Texas Instruments up 18, XBI, the small cap biotech ETF, up 12%, and the KWEB is up 14%. Okay, so Amazon and Meta are the two best performers. Meta was up a lot because of how AI helped their sales, and they were helped by the election because there's a lot of advertising around the election. So Meta won't have that next year for its tailwinds. So I like to see what he thinks is the next five best picks for next year. And all right, so let's look at some of the charts of interest. I already showed this one to you. We have the XLU. This company, this is the utilities sector ETF. You can see that it's oversold, near the bottom of it's around 30 in the stochastics, and we're at the bottom of the channel. So some of the tailwinds for this, things that will help it, are the AI infrastructure build out. We have an unsatiable demand for electricity due to artificial intelligence. Um, and we might have deregulation. So those are all things. Right now, all these utilities are super regulated, and just a little bit of help with deregulation might help them raise their prices and other things like that. So let's watch that sector. Um, okay, we're going to review this because it's pretty important. The sectors of the stock market in a Trump presidency. Um, the financials sector is a clear winner. They're going to have deregulation, so they're going to be able to free up more money to invest and to lend to people. Right now, a lot of the banks have to hold back money just in case a worst case scenario. And if they free some of that money up, that will help them grow. Um, utility sector, uh, we have we have a new incoming pro-growth administration that's going to help a lot of the country build and use more energy. So that could help that industry. Um, the new administration wants lower interest rates. So that would definitely help the real estate sector. Right now, it's one of the worst for the past 2 years, but that sector might be helped by the new rules. Um, energy sector, um, we have a dichotomy. If there's a lot of benefits given for drilling for American oil companies, you'll have more oil pumped, and that will reduce the amount of oil, making companies less profitable. So we don't know how that's going to work out, but it should be good for the energy sector. Um, the ones, yeah, we do have a lot of stocks in like a bullseye, like the healthcare sector. Um, there's supposed to be less spending on drugs and more negotiating. There's a lot of things that could go wrong with healthcare in the next 4 years. We don't know, but we have the IT sector. We have a little bit softer stance on some of the big companies. So if you have new people in the administration for antitrust, you might have a lot of these suits dropped for the big tech companies. We don't know, but that could be in general better for big tech. But let's look at what has performed best since the election. We see that financials, that's an obvious clear winner from deregulations, are the best performing since the election. Consumer discretionary, um, you see. So we have um, possible tax cuts. That means customers, I mean, the people of America will have more money to spend. So they have more money to spend on big ticket items, which is kind of the discretionary sector. And energy has done best since the new administration. So this could be what continues in the next year as some of the better performing sectors. The worst performing, healthcare. We mentioned that has a lot of new administration has a bullseye on healthcare companies and some of the drugs that they approve and or um, pay for. And consumer staples is some of the worst, and real estate. And we'll just keep our eyes on this and see if this trend continues into the next year. And okay, let's look at okay, so this is an article. Dow jumps nearly 200 points today to record short session on the day after Thanksgiving today. We have a half day. So S&P posts the best month of 2024. So our seasonality, where November, December are good, it turned out pretty good this year. Um, so one thing that Bespoke Investment Group said that's pretty important, we haven't had a 10% pullback in quite a while. We average one once a year. So we haven't had one for a while. So if we have a 10% correction, you can't go and sell everything. It's just something that happens every now and then. So let's look at our S&P chart. If we had a 10% correction, we'd probably come down to here, and that's below all the moving averages. Why would we do that? I don't know. We have to have some kind of major announcement or some kind of major geopolitical event right at this point in time. But as a long-term investor, you have to understand that pullbacks are part of a long-term investing part of life. If you're a grown-up, you have to be willing to sit through 10% corrections. And so far, we're up 26% this year. So, and it's going to be the best year since 2021. So this year has been one of the best years in quite a while. And um, we had 2 years of 20% gains in a row in the stock market. So it's not very often that we have three in a row that's 20%. So don't be surprised if we do have a 10% correction. It's just um, part of being an investor, a long-term investor. Okay, this week we had a FTC opening a wide-ranging antitrust probe into Microsoft. Um, so Microsoft, we know that Microsoft has a monopoly in Office and Windows, and they're allowed to have that. They went through an antitrust 30 years ago, and they kind of came out of it unscathed. One problem with these antitrust lawsuits against companies is that distracts them. Microsoft was distracted whenever they were sued about the Internet Explorer browser way back 30 years ago. And Bill Gates didn't put his best engineers on the mobile development. So they totally missed out on being the primary mobile app operating system for phones. So, okay, this article is Dan Ives actually said that it isn't a worry. This whole antitrust issue is going to blow away, and it's not a cause for concern for investors. Um, they've already been in a battle with the U.S. government, and he says this suit is much more bark than bite. It will fade away. Let's hope so. But we don't know what's going to happen there. But right now we can see with Google, it's affecting Google stock. It's not Google isn't appreciating like the other stocks. It's being held back. And until all this is resolved, the stock isn't going to trade at a premium. Um, so I did a screen this week. We have this, we've, what I've been doing is I've been going over some of the some of the stocks on our screener and to see if it has any um, just to learn something about the stocks that we see on the screen because we can't go through all of them. One thing I noticed about the screen this week is we had a lot of banks on on the top performance on our screener. So we have Morgan Stanley, we have Royal Bank of Canada, HFC Bank Limited, a lot of banks. So I thought, hmm, we have a new administration that's going to be better for the banks. That is a huge tailwind. We have some, let me see. So we have a lot of banks here. I thought it'd be interesting to go through a Morgan Stanley. This is a company that is a bank, and it's also an investment company that does investing for small people. It also does investment banking, which is kind of advising on going public and things like that. So, and that's going to be helped by the new administration. There's going to be a lot more IPOs. So I thought it'd be interesting to go through that company because it's around the PEG ratio of 1, which is our target. So it's fairly valued, hopefully. It's growing around 19%, return on equity 11. Okay, so it seems like it has a pretty decent numbers. So I thought it'd be interesting to go through that. Okay, you can see that we have an increasing earnings estimates year over year. Um, Last year to this year, it's 40%, 8%, and 10%. So let's say they're growing at around 10% average. Their forward PE is 16, so they're about 60% overvalued right now. You can see that they had a huge Trump bump right there. They were like in a pretty much in a doldrum for like a past couple years. So you can see that they're having a little bit of tailwinds from the new administration. Um, so it's a little bit overvalued according to my metrics, the way I look at things. Um, Tailwinds, things that could help it, are deregulation, investment banking um, is favored in the new administration, and deal making IPOs will increase with Trump's agenda. Let's look at some of these statistics. We have a forward PE of 16, a PEG ratio according to Yahoo of 3.8. So according to Yahoo, Morgan Stanley's only growing at like 4% because if you divide 16 by 4, you get 4. So there's something off here. Um, we can't be super sure we're getting this. Well, we know it's overvalued. The profit margin is decent. We like 13 or so, and return on equity is adequate. And you can see the total cash, total debt is they only have around 100 billion in debt, which is pretty good. And they're a bank also, so they have to borrow money to lend the money. So we can't really count on the balance sheet. You know, having a lot of money borrowed by a bank is not a big deal. So I'd say it's a little bit expensive. Um, Another stock on on this chart is Eli Lilly. You can see that Eli Lilly went down like 20% since the Trump administration, since Trump won the election. So because of that, it seems like a lot of the numbers are kind of fair value right now. So I thought it'd be interesting to go back and look at Eli Lilly and look at their growth and see if it's even worth looking at now. You can see that they're growing around 32% now. And they have an insatiable demand for their product, which is a weight loss drug and diabetes drug. So they have a 99% cure rate on a certain kind of diabetes, which is pretty important. And the government this week said that they would pay for this drug at Medicare. So that gave this stock uh, like a 5% increase. So we have a company that's growing around 30%. Their forward PE is 39. So their PEG ratio, it's only 20% overvalued right now. And you can see their price has substantially gone down since the election. And let me see. So we have the tailwinds. They have an insatiable demand for their product. So we have, but they're building many factories to ramp up the production. Not too many companies can afford to ramp up production to meet the demands for this. So they're actually, in a year or two, they'll have a lot of this on supply available, and when all their competitors won't. So those are all positive things. Um, the headwinds, the new administration might not be favorable to healthcare and especially weight loss drug categories. All right, so let's look at the statistics on Eli Lilly. According to Yahoo, it's undervalued by 17%, 0.83 PEG ratio. You can see that the 4PE is 39, according to Yahoo Finance, and profit margin is double what we want, and return on equity is like four or five times what we want. So it's really good. The amount of debt is negligible. I'd say their total debt compared to market cap is 25 billion. So they have a market cap of 800 billion. So that's a very small amount. That's manageable. So this is a good stock. I like this stock a lot. It's a little bit expensive right now. It's 20% overvalued. But if you don't have a healthcare stock right now, it pays a dividend and it's growing around 30%. And it's kind of out of favor right now. So as a contrary investor, you can see that um, it's still growing. Let's look at, and this is their chart. You can still see it's in an uptrend, but it's um, it has this little bit of a downtrend right here. You see that? We don't know if that's going to turn into a long-term downtrend or continue its uptrend up to here. So we're at a decision point right now. Okay. So there's another article by the Motley Fool. If I could buy and hold a single stock, this would be it. Um, and the guy was saying, well, he was considering Amazon because of their diversity. Both they have a cloud infrastructure business and they have a retail business and they have a delivery business and an advertising business. They're very diversified but they're mostly in tech. Same thing with Google. Google is or Alphabet. They are 90% of their money comes from search, and so they're pretty undiversified because most of their money comes in using for tech. But Berkshire Hathaway is more diverse. They have a diverse portfolio of businesses. One good thing about Berkshire Hathaway is they're not as affected by some of the Trump administration changes. So Berkshire Hathaway is considered a financial, so they'll be in general helped by the new administration, and they're not going to be as affected by tariffs because a lot of their businesses are in America, and such as Geico and um, BS, BNSF Railway, Kraft Heinz, Dairy Queen. So you have a lot of American-based companies that aren't necessarily affected by tariffs. So it's for the next 4 years, this could be a very conservative business to buy and hold, and it would work through almost any administration. So they have like half of their um, investments in actual stocks outside of their company, and they have a certain amount of wholly owned companies. Um, so so an example of a stock that's well diversified. If the stock market dropped tomorrow and everything dropped in half, this would be one stock that you can buy and hold, and they would do well over a long period of time. Okay, so that is what I had for today. I hope you enjoyed the talk. If you have any questions, please let me know, and I'll try to help out. And hope you have a good week ahead, and I'll see you next time.